Hi, and thank you for joining us. This report provides a financial quarterly trend analysis for Nike Incorporated. The US based company started in the state of Oregon in the year of 1967. Nike has grown to be the world's largest distributor and manufacturer of athletic footwear and apparel. Currently, publicly traded on the New York Stock Exchange under the symbol NKE. Nike Incorporated also owns Converse Inc. and Hurley International, both subsidiary brands covering a more specific market segment. So why Nike? We chose Nike because it was appealing to us in a couple of different levels, or in different levels. At a more personal level, was our team's shared interest in leading a more physically active lifestyle. At a business level, it became more interesting as it was the only brand our extremely diverse group members all currently utilize to exercise. And then at a social level, we find how revolutionary their Just Do It campaign was, as it managed to define the athlete of our time. Now my teammates will tell you more about our project. First, we'll see Sacrea Simmons with the financial analysis, then Candy Urias with the industry performance comparative financial analysis. After, Christopher Diaz with the comparative SWOT analysis, then Lisette Castañeda with the market opinion, and finally, Luis Gabriel Bárcenas with our conclusion. Thank you for joining us.
Good evening, my name is Candy and I am with Group 8. Today I'm going to be talking about the comparison of Nike versus the industry. I'm going to talk about the debt ratio, inventory turnover, liquidity, and the inventory turnover. To start, let me start talking about the debt ratio. Nike's low debt ratio, or ability to pay the back long-term debt, could help the company negotiate lower interest rates or long-term loans. As we can see, on Nike it's at 0.43 and the industry is at 0.09, so it is a good standing for the debt ratio for Nike. Inventory turnover ratio. The inventory turnover ratio tells us the efficiency of Nike managing and selling its inventory. It also helps to determine how they can increase their sales through the inventory control. Currently, Nike is at 3.79 and the industry is at 5.24. Now, if the inventory has a low inventory turnover ratio, then there is a risk they are holding obsolete inventory which is difficult to sell. This may eat the company's profit. However, the company may be holding a lot of inventory for legitimate reasons. They may be preparing for a holiday, for example, now Christmas season. In the case of the retail industry, preparing for a strike, among other reasons. So let me move on now to liquidity ratio. Nike is above the industry average. That means that Nike's ability to meet short-term debt obligations is a bit risky. Nike would have a better luck getting short-term loans from lenders. Again, Nike is at 2.80 and the industry is at 1.70. Profitability ratio. In comparing both ratios, we can conclude that the financial health of Nike is at a great standing. Again, 0.70 versus the industry 0.09. Thank you.
In this financial analysis segment, we will discuss liquidity, asset utilization, profitability, debt utilization. We will begin by taking a look at the liquidity ratio. In quarters 1 through 3, it is shown that the current ratio encounters slight but significant increases, demonstrating an improvement in its ability to pay off its debt. Although quarter 4 shows a quarterly decline of 0.26, from quarter 3, it carries a ratio of 2.8, indicating that the company's assets are greater than its liabilities, and it is able to pay off its obligations. As seen in the analysis, there is some slight variance throughout quarters 1 through 4. However, the ratios remain above 1 majority of the time by more than half. This indicates that the company has a strong ability to pay off its short-term debts without having to worry about borrowing future capital. Inventory turnover ratio, a component of asset utilization, demonstrates to investors that a company such as Nike has products that can be liquidated quickly. As exhibited in the numerical analysis, we see that beginning in quarter 1, Nike holds a strong inventory ratio of 1.01. As the year continues from quarter 1, there is a decline in the ratio. With careful consideration, it can be assumed that the increase in the average inventory impacts a decline in the ratio. Profitability ratio centralizes on a company's ability to generate earnings compared to its expenses during a specific period of time. As for Nike, we notice that the company's ROA, return on assets, ratio was 0.06, indicating that a company is earning 6 cents for each dollar of assets. As the year continued, we noticed that a slight decline in the ROA from 0.06 to 0.04 then stayed steady. The net income decreased from quarter 1 to quarter 2, having an impact on a decreasing ratio. The company indicates a reliability in generating net income for the entire year. The return on equity ratio measures equity holders' ability of earning returns on their investments. The return on equity ratio shows the company's net income increased on quarter 1 and quarter 3. The analysis shows throughout the year that Nike's profit margin exceeds that of what is expected for retail companies. As a result, the company demonstrates its ability to effectively keep its expenses lower than its revenue. Debt utilization and market ratios. Debt utilization measures a company's use of many financial channels to increase potential returns on an investment. Nike has consecutively kept a debt ratio lower than 50% throughout all 4 quarters. Market ratios is an indication of how well the company is doing in a wider marketplace. Although experiencing a slight decrease in its earnings this period, Nike's earnings demonstrates the company has a solid financial health in the wider market, with its lowest EPS ratio being 0.46.
Hello, I'll be going over the graphical analysis for the Nike company. Now, I'm not sure if you guys are following me or not, but I'll be going through this basically pretty quick since it's a lot of graphs. Excuse me. Starting off with the current ratio. And I am going over this with you guys as we speak. You guys have the copy of it, but I did updated it and it's a little bit more. The quick ratio, the current ratio. As we see here on the graph, the current ratio, as we know, measures a company's ability to pay short-term and long-term obligations. The current ratio, as seen here, has a downward trend on the third quarter. Even though it has an increase from the first and up to the second and to the third, it does have a tremendously a fast drop on the fourth quarter. Basically, what it means is increasing its liabilities is the root of this downward slope. It has more liabilities as it went into the end of the year. Looks like the company were paying their debt on time until the third quarter, so it looks like their ability to pay their debt is not looking good by the end of the year. The quick ratio. The trend for the quick ratio shows an increase here, as we see from the first to the second quarter. However, after the second quarter, there's a huge decline as well. The company is not stable for the remaining year. This tells us that the company might not be able to meet its short-term liabilities if it keeps dropping. Net working capital ratio. Net working capital ratio is decreasing since the second quarter. The company does not have a good indication, or which basically means it does not have a good indication that it is able to pay off its short-term debt in time. Similar to the quick ratio graph, the net working capital ratio graph shows that the company does not have enough short-term assets to cover its short-term debt. Current liabilities to inventory ratio. Thus, though the current liabilities to inventory ratio is decreasing, as seen here from the second to the third quarter, It seems to be slightly rising by the third quarter or up to the fourth quarter. The rising trend could be a red flag if it keeps increasing. Cash ratio. Cash ratio is basically the amount of cash or equivalents to cover current liabilities. In the graph shown here, the cash ratio increases up to the third quarter and then decreases significantly for the remaining year. This is not a good indication. The company seems to struggle on paying its short-term debt. It also means the company is having a decrease in current cash. Operating ratio. The operating ratio basically defines a company's operating expenses as a percentage of revenue. The operating ratio has slightly increased up to the fourth quarter, as shown here on the graph. This basically means the operating expenses have been decreasing and the company is improving its efficiency. Inventory turnover ratio, the fixed asset ratio, and the total assets ratio. I'll be going over those pretty quick as far as talking about them together. The inventory turnover ratio, fixed assets turnover ratio, and the total assets ratio all show a similar pattern, which basically appear to reflect the seasonality and sales in certain times of the year. Fixed assets and total assets ratio are steady, which means they are using their assets effectively, which is a good thing. Inventory turnover ratio decreased, but then increased in the second quarter, meaning it was selling its inventory effectively and is steady or selling it steadily by the end of the year. Asset to equity ratio. The asset to equity ratio is basically the total assets of the firm to the portion owned by shareholders. The assets to equity ratio shows here a gradual increase, meaning sales are strong and have increased for the year. Liabilities, it also means liabilities have decreased as well. Return on asset ratio. Return on asset ratio is an indicator of how profitable a company is relative to its total assets. The return on asset ratio is shown here decreased in the second quarter and then stay steady for the remaining year. This means the company is reliable in generating net income with respect to its assets. Return on equity ratio. The return on equity ratio shows the company's net income increased in the first quarter and in the third quarter. However, the overall trend over the last 4 quarters indicate a decrease in this ratio. This means the ability for the firm to generate profits from its shareholders has decreased or is not generating share profits from the shareholders. The profit margin ratio and the basic earnings power ratio. We get the profit, of course we all know we get the profit margin by dividing the net income by the sales, and we get that ratio. The basic earning power ratio calculates the earning power of a business before the effect of income taxes. Both the profit margin ratio and the basic earning power ratio appear to be very steady throughout the whole year. Earnings per share ratio. The earnings per share ratio is the portion of a company's profit allocated to each outstanding share of common stock. The earnings per share ratio shows a slight decrease for the year on the graph above. This means the number of outstanding shares have been steadily increasing, then decreasing from quarter to quarter. Total debt ratio. The total debt ratio can be used and interpreted as the proportion of a company's assets that are financed by debt. The total debt ratio is on a slightly upward trend, with liabilities decreasing and assets increasing. This means the company has a good financial leverage. However, it has to keep its inventory low if it continues to increase. The interest coverage ratio. The interest coverage ratio shows a decrease for the remaining year. As we all see here on the graph, it just keeps dropping. It increases just a little bit on the third quarter, but then it drops overall to the fourth quarter. This can be a red flag if it continues to drop. What this basically means is that the company's ability to meet its interest expenses is a big concern. They probably won't be able to meet those expenses if that keeps dropping. The debt to equity ratio. The slight increase in debt equity ratio, as shown here, shows that total liabilities have increased for the year. It just keeps increases from first all the way up to the fourth quarter. The graph also shows us the company is using a lot of debt towards the end of the year to finance its assets. And that basically concludes the graphical analysis for this company. Thank you.
Hi there, I'm Christopher Diaz. I'm going to talk to you about Nike's SWOT analysis. Just to start off, I'm going to start with the strengths. Nike has a 0.3 annual ROE compared to the industry average of 0.15. This signifies that investors can feel comfortable knowing that the company managers can handle your money and make wise investments with less upfront, generating more revenue. Now, another strength that Nike has really is their co-founder Philip H. Knight, as well as their CEO Mark Parker and his influential executive board. With the advancements within the realm of wearable technology, Nike can only improve upon what they have started, as well as improve upon what others have started. Now, their weaknesses. Nike is the company that just does it. Nike HyperAdapt is an opportunity within the world of technology integrated into fashion. It does come with a high price tag of $720. Just released in December 1st, there's by appointment only, and with a 10-year-long project, hopes may not be high. It may be the Sony Walkman, but is it Nike's Apple iPod? Maybe next year we'll see what Doc Brown has in store for us. As we were talking, the Nike HyperAdapt it comes in a sophisticated box of self-lacing shoes. With a new adaptation with wearable technology, we find in the box 2 power plugs that stick onto the bottom of the shoe to ensure that at all times you know what battery, what power you have in your shoes, and in the heel automatically they zip up. This is a great opportunity for Nike. There are many in the industry that have wearable technology, but Nike has been the first to actually take Back to the Future concepts and make them into a reality. Now, as I was saying, their threats are, they're not the only people with wearable technology. There's Apple's watch, with Nike partnered with. There's HyperAdapt shoes, which are Nike's. The competitors such as Under Armour, Fitbit, Misfit, and others such as crowdfunded fitness device Move are showing that not only has technology entered the world of fashion and apparel, but it also shows that technology has leveled the playing field for underdog competitors to mimic, enhance, and demolish a competitor's product. The apparel industry that bolsters Nike's apparel has faltered in a decline as consumers are purchasing more online, on Amazon, and aren't getting out as much into the stores as much as they're spending money on high-end products. These are Nike SWOT analysis. Thank you.
Okay, my name is Lisette and I will talk about what the market thinks about Nike. For that reason, we're going to use some of the analysis recommendations that the investors have done. This analysis shows that on average, Nike has a fundamental value of $62, which means that in the long term, the stock price should be around that value. Today's the price, the stock is 52.30 cents as December 13. That means that in the long term, the stock will be gaining 20% of the value. And for that reason, an investor will be interested in buying this stock. Also, these graphs show that the market opinion for investing banks, as Goldman Sachs and JP Morgan and others, shows that the majority agree that the stock is a buy, as we can see the numbers in green. So basically, it's all buys or strong buys. Thank you.
Hello everyone, my name is Luis Barcenas and we are here at the end of this presentation. And basically the end is these 3 questions that we were tasked. So basically these are some decisions that we're supposed to make based on the findings that we have made throughout this entire project. So question number 1 is, would you place a personal deposit of $1 million or more in the publicly traded stock of this company, in this case Nike? And the answer is yes. I mean, over the past couple of years, Nike has lost some of its Wall Street flair as attention has instead diverted to other companies, to other smaller companies, which are their competitors, like Under Armour, for example. But the analysis shows that, while it's perhaps time to recall some of the world's largest sportswear maker back into your stock portfolio, it's important to have some of that Nike, apparel and just do it mentality into your portfolio. But the bottom line metrics is still running strong. So Nike is still a strong buy. Breaking the ice is the company's recent 4th quarter earnings result that has yet again delivered strongly. Adjusted net earnings for the quarter at 49 cents a share beat the street's estimates by a penny. That's 2 for the 9th consecutive quarter. The company's net income margin has grown an average of 11.5% over the past 5 quarters. And basically just, it's making the stock very, very appealing and very attractive for investors. Targeting the upscale end of the market with meaty price points has also pushed with the high-profile athletes, sponsorship, and creative marketing campaigns that Nike has been part of, which make this company overall very, very, very attractive. Question number 2 is, would you invest $500,000 in the debt bonds of Nike? That's also a resounding yes. Currently, the Beaverton, Oregon-based company has only 3 long-term maturities on its book. There's a $5 million, 2.25% maturity or yield. These notes are due in May of 2023. There's another $500 million at 3.625% due on May 2043, and $1 billion at 3.875% notes due on November 2045. This makes this company again very attractive to buy and to acquire as far as the bonds goes. We can see that the maturity rate for the bonds is pretty solid, and it's something that is definitely going to pay off in the long term. If we move forward to the last question, which basically states that if you were a member of the board of directors of a bank and you sat on the bank's credit committee, which I hope I eventually someday do, would you grant a $1 million line of credit for overnight or term federal funds to this company? And again, the short answer is yes. I mean, as we all know, the overnight market is the component of the money market involving the shortest term loans. That's what I call overnight. This is basically the lenders agree to lend borrowers funds for a short period of time, and the borrowers usually repay this borrowed money or these funds plus some small interest at the start of the next business day or after a couple of days after the money has been funded. Nike is a very solvent company and is able to quickly repay these short-term loans without a problem. They're very fluent when it comes to their cash flow and funds basically. And besides, I mean, $1 million for a company that it's in the billions in revenue, it's not going to make a big difference for them to repay. And with that, I want to say thank you, Professor, for all the time that you have spent on listening to this presentation. All of our Group A members are here, and we're wishing you a Merry Christmas. Thank you very much.